Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Hang Lung Properties Limited annual report. Hang Lung Properties Limited offers a diverse range of businesses and services to cater to the needs of its customers. At the core of its operations are property development, sale, and leasing, which include commercial complexes, retail spaces, office buildings, residential units, and serviced apartments. The company also provides property management services, ensuring that its properties are well-maintained and efficiently managed. Additionally, it offers car park management to provide convenient parking facilities for customers. Furthermore, Hang Lung Properties Limited operates hotels, providing accommodation options for travelers and locals alike. To enhance the customer experience, the company has introduced innovative services such as the Hello Hang Lung Mall Rewards Program and House 66, a customer engagement business that aims to build strong relationships with its customers. These initiatives demonstrate the company's commitment to delivering exceptional service and creating memorable experiences for its patrons. Hang Lung Properties Limited market capitalization of $44 billion is significantly larger than the average industry peer of roughly $1 billion. This shows that Hang Lung Properties Limited holds a significant advantage in their industry. Hang Lung Properties Limited trades at a higher price-to-earnings ratio of 23 times and a lower price-to-book ratio of 0.33 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The company maintains a moderate leverage profile, with liabilities making up 36% of total assets, suggesting a balanced approach between risk management and capital efficiency. Liabilities have increased, while assets and equity have failed to keep pace or declined. This suggests the business is not growing and may be in decline, making it a highly unattractive investment from a risk perspective. Shareholder equity has weakened over the past 5 years, accompanied by declining or negative operating income. This suggests the business may be eroding shareholder value and warrants caution. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The company have a dividend yield of 6%. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The primary drivers of revenue growth for Hang Lung Properties Limited can be attributed to several key factors. Firstly, an increase in property leasing has contributed significantly to revenue growth, with a 6.4% rise in lease income from operating leases. Additionally, hotel revenue has seen a substantial surge, increasing by 57.1%. Building management fees and other income have also experienced growth, while interest income and dividends have increased as well. On the other hand, the primary drivers of revenue decline for Hang Lung Properties Limited include property sales, which saw a significant decrease in revenue, with a decline of 71.1%. Hotel revenue has also declined, contributing to the overall decrease in revenue. Furthermore, currency risk, technological innovations, and cybersecurity incidents have all had a negative impact on the company's revenue. The company's revenue decreased by 2% in 2025 compared to 2024, indicating a mixed performance across different segments. However, it is essential to note that these findings may not be comprehensive or up-to-date, and further analysis is required for a more accurate understanding of the company's financial performance. Net income and profit margins. A tale of 2 years, the extracted summaries reveal a mixed bag when it comes to net income and profit margins. On one hand, the company's net income saw a significant increase of 57% from $189 million to $197 million in a particular year. However, this trend was not consistent, as the net income decreased by $100 million from $6,763 million in 2024 to $6,663 million in 2025. Profit margins also underwent a change, albeit a decline. The operating profit margin decreased from 42.1% in 2024 to 38.3% in 2025, while the net profit margin dropped from 20.2% in 2024 to 15% in 2025. These changes can be attributed to various factors, including a decrease in net interest expense and an increase in other net income, which indicate an improvement in profitability. However, higher estimated development costs and or higher estimated profit margin resulted in lower fair value of investment properties under development, contributing to the decline in profit margins. The reasons for these changes are not explicitly stated, but can be inferred from the data provided. The company is indeed generating positive operating cash flow. This is evident in the various financial statements provided, which consistently show a surplus of cash generated from operations. On page 158, it is noted that the company has generated $156 million in cash from operations, indicating a positive trend. Furthermore, on page 164, the operating cash flow for both 2024 and 2025 are reported to be $4,956 million and $5,864 million respectively, both of which are positive. Additionally, on page 201, it is stated that the company has generated $6,387 in cash from operations for 2024 and $7,074 for 2025. These figures also demonstrate a consistent generation of positive operating cash flow. Overall, these financial statements confirm that the company is generating sufficient cash to meet its operational needs. The company's debt level and interest expenses have undergone significant changes in recent years. On the one hand, total borrowings have decreased by $3,787 million, indicating a reduction in the company's overall debt burden. However, net debt has increased by $181 million, which may seem counterintuitive, but is likely due to fluctuations in cash flow and other factors. In terms of interest expenses, there is a notable decrease from $920 million to $184 million, representing a 4.1% reduction in net interest expense. This decline can be attributed to the company's efforts to manage its debt and reduce its cost of borrowing. Furthermore, the average effective cost of borrowing has fallen significantly to 3.8%, down from 4.3% in the previous year. The decrease in debt-to-equity ratio from 40.7% to 37.1% also suggests that the company is becoming less leveraged and more financially stable. Overall, these changes indicate a positive trend in the company's financial management, with efforts to reduce debt and lower interest expenses contributing to its improved financial health. Management is committed to transforming the company into a leader in sustainability, aiming to achieve net zero greenhouse gas emissions by 2050. This vision is guided by a strategic framework known as V3, which focuses on highly selected investments that leverage existing assets in core cities to drive long-term value. To achieve this goal, management has adopted a conservative approach, prioritizing downside protection over upside potential. This involves investing in initiatives that increase presence in core cities with lower capital expenditure costs and shorter timelines. The company's Palace 66 location is already reaping the benefits of this strategy, achieving record-high tenant sales and positive occupancy rates through enhanced customer experience. In addition to its focus on sustainability and strategic investments, management is also prioritizing community engagement and adapting to evolving urban lifestyles. This includes revitalizing surrounding areas to create vibrant destinations for culture and leisure. To drive sustainable growth, the company has implemented 5 overarching strategies: being customer-centric, building branded experiences, embracing technology, executing with discipline, and upholding its core values. Overall, management's outlook is centered on creating a more sustainable and resilient business that prioritizes long-term value creation over short-term gains. By focusing on strategic investments, community engagement, and technological innovation, the company aims to establish itself as a leader in the real estate industry while minimizing its environmental footprint. The company's financial strategy has been focused on rewarding its shareholders through dividend payments. According to the dividend and share buyback summary, it is clear that the company has indeed paid dividends. This decision demonstrates a commitment to sharing profits with investors, which can be seen as a positive sign for long-term growth and stability. There are no explicit concerns about inventory buildup or supply chain disruption mentioned in the report. However, there are a few potential disruptions that could impact operations. One such concern is the renovation of Old Supermarket, which may cause temporary disruptions, page 42. Additionally, high vacancy rates in an office tower, page 47, could be related to supply chain issues, although this is not explicitly stated. Furthermore, construction related to a new footbridge connecting the East Kowloon Cultural Center may also cause temporary disruptions, page 58. While these potential disruptions are mentioned, they do not appear to be major concerns at this time. That concludes the financial summary for Hang Lung Properties Limited. Feel free to comment below, and I will be happy to answer them when possible.